Welcome to the Retirement Lifestyle Show. I'm one of your co-hosts, Adrian, and today I'm joined by Erik. Erik, it's great to have you back. I'm excited for another episode of the Retirement Lifestyle Show. I'm very excited to get started today. Erik, how have you been?
I've been really well. I suppose we've been unburying from snow here in Michigan, but nothing like some other places around the country. Have you been reading the news about what's been going on in Texas and stuff like that?
Yeah, I actually have some family down there, and it's definitely a new thing they're dealing with because it's always sunshine and blue skies. But yeah, it's just dealing with it the best you can. But I'm glad you're back, Erik. Roshan's unfortunately out today, but we had a great conversation on our last episode. We talked about people that we'd be interested in having a future podcast interview with, the people that we'd enjoy doing that with. We also touched on cybersecurity and how that's important to the individual. It was a great conversation. I'm looking forward to another great conversation with you, Erik.
Yeah, great. I'm looking forward to it too. So we're talking about the distinction between investing, trading, and speculating. And Adrian, why is this important?
Yeah, I think this is going to be a great topic today and a great conversation to have. These are all really great and important strategies to really put your dollars working in the financial markets. And it's extremely important to understand the different principles, the different aspects of it. And three important factors that we're probably going to discuss today is the time element of each one, the risk element of each one, and the overall results and profits that you could potentially make and how you employ them is going to be extremely important. And I'm really looking forward to having this conversation with you, Erik, to just kind of talk about examples, talking about ways you can just implement it, seeing how this could be a part of your overall financial picture.
Mm-hmm. And if I could, I'm going to add to your explanation of importance, because there's another element that occurs to me is I think when a person doesn't make this distinction between these three different things, investing, trading, and speculating, while I certainly recognize there's overlap, when they're not making the distinction, sometimes they'll allow their investing to take on properties of trading and speculating. And sometimes they'll treat their approaches to speculation more like investing. And when you, I think, misapply the principles and strategies from one category to the next, I think you wind up sometimes with some adverse results. So I'm not saying, I'm not prepared to say that necessarily every one of our listeners ought to be engaged in every one of these three categories, investing, trading, and speculating. But I certainly would say if you do, and they may have a role for you, then understanding the difference helps you not misapply the management principles and the selection and management of your investments, trades, or speculative positions in such a way
Yeah,
that's
Erik,
going to damage you.
that's a great way to start us off. And I think also a big thing is the suitability aspect of that
Mm-hmm.
as well. We always say that we have to look at a financial picture on the individual level. It's extremely important because everybody's situation is different, and just seeing how we can incorporate different strategies into your situation and how we allocate certain aspects of your financial resource to each one to see what can work, what doesn't work, what are the important risk control elements that we can take place, and overall just have that conversation to layer out those options, I think is extremely important.
Mm-hmm. So let's maybe just start with definitions. So how would you define investing?
Just the basic understanding of investing is just buying shares into a certain asset class, whether it may be a company, whether you're buying a bond, mutual fund, ETFs, alternative investments. The list can go on and on, and you buy into these with the expectation or the hope of capital appreciation, receiving some sort of dividend or interest payment from it, or receiving some type of distribution to help you uh, to help structure your financial resources in a way that can help produce a positive result for your financial future.
Mm-hmm. I'm going to add to that because you mentioned stocks and bonds, and I think of those as as primary: stocks, bonds, mutual funds, exchange traded funds, all these different variations or ways of investing in publicly traded securities, things that are on an exchange or things that are otherwise publicly available. But I would also say you could add to that private investments. So buying a business directly, or building and starting a business in a sense is a similar form of investing. It's not as diversified necessarily, and so your risk is more company specific in that particular instance. But I think that also qualifies. So you mentioned, as we were preparing for the podcast, the time element. So talk with me about the time element of investing. I think it's probably self-evident for most people, but it serves as a useful contrast with the other approaches that we're going to talk about. So how do you think about the time element for investing?
The time element is extremely important. And again, this comes down to the individual. When are you going to be required to use these investments, or when do you need? Just looking at your overall picture is extremely important. And when it comes to investing, it does take a lot of research. Looking at certain asset classes and see how it fits into your picture is an extremely important element of it.
Mm-hmm. So I think when I think about investing too, Adrian, I think what's the default action that a person could take? Well, a person is saying, hey, there's certain phases in my life where I have more resources, and then there are other phases where I have fewer. And so generally speaking, when you're fresh out of school, you have fewer. But you're trying to get some things rolling, and so maybe you buy a house and you're doing that on debt. Then as time goes along, hopefully there's a crescendo in your income and in your savings, and then hopefully a decline in your indebtedness if you took on indebtedness. And but ultimately what you're trying to do is to shift resources from one time period to a different time period, right? And particularly since you and I and Roshan, when he's with us, is primarily serving clients who are trying to solve the single biggest liability that they're going to face, which is funding their lifestyle when they're no longer earning a paycheck. Then for that in those cases, we're saying, hey, let's take resources from those periods where you have a surplus and move it to this period where you would otherwise have a deficit. So the default approach you could take, of course, is just to store it in cash. And some people actually do that. They'll just build up massive reserves of cash. And you certainly can do that. Although our view is that if you are of such a, if you have the inclination to do this, you could put it to work in such a way that while you're waiting for that eventual deficit time period to arrive, it could be working for you. It could be working for you. And if cash or CDs were paying something real, then that might be a strategy. But instead, you're relying on something else. So when you're investing, what if you were to sort of vocalize, Adrian, what you think it is that people are banking on when they invest? What is it that they're counting on happening, and why? What is it that's the fundamental underpinning of their belief that if they invest it, there will be a return on that investment long run?
Yeah, that's a great point, Erik. Just having your assets grow over time is an extremely important part of this. And also, like you said, there are situations where people may have it all in cash, or there might be a situation where people mostly focus on a particular asset class, like equities. And this is when we bring in the conversation on the importance of diversification, because that's an extremely important element, as well as correlation, seeing how heavily your assets are correlated. Do they move all together? Do they move in different directions? Are they properly diversified? Whether if this asset class isn't doing well for a couple of years, you have ones that can make up that approach. I think is extremely important. And then it comes down to different styles of investing. There are passive investment styles. There are active. There are more tactical ones, and all of them have their different costs and fees that go into it, which is another important part of investing, because this in turn could save you a lot more money or cost you a lot more money, and it can play a factor into your overall return as the years go on. It's really interesting. It's something that does take a lot of time and does take a lot of research. But again, this is a very important part of your lifestyle. And when it comes to funding certain aspects of your lifestyle, we always talk about longevity, and that's a very important thing when it comes to structuring your assets in a way that are consistent and that can provide you with funding over time.
Mm-hmm. So, well, I think that's useful. All the things that you just detailed there, Adrian. So I'm thinking about the thesis behind investing, at least for me, is a belief that long run economies grow, and the drivers of growth in those economies are fundamentally businesses. And so, if I can invest in a business that's growing, and I can wait it out through ups and downs and interest rate changes and contractions and expansions and so forth. But if I can just wait it out, then X number of years, 10, 15, 20, 30 years down the road, what I put to work long ago will produce for me. I expect, I can't guarantee, I'm not guaranteed, but I have an expectation that it'll be there'll be more to spend, more to give, or more to do something with than if I had just left it in a mattress. So, but there's no expectation, I think, that there's no expectation of sudden increases in your wealth. But that leads me to think then about trading. How would you define trading?
Well, there are examples of trading today where and it might sound foreign to some people, but people can buy and sell a particular security within a day, going in and out of positions. This is
Mm-hmm.
an example of trading where they're trying to capitalize on certain price movements and swings is a common form of trading.
Mm-hmm. So to trade is to say, I'm going to take a position in some security, usually, because it has to be liquid. So you couldn't do this in the McDonald's down the street and buy it for a handful of days or something like that. But take a position in a security of some kind with the expectation that in some shorter period of time, whether it's seconds, minutes, days, weeks.
I've even heard of nanoseconds, Erik.
I can tell some stories. So not because I personally was a nanosecond trader, but in an earlier chapter of my life, I was a trader, and I was working with a hedge fund, and the sort of the genius behind this particular hedge fund was a programmer, and he had co-located his computers at a point that was as close to the exchanges as you possibly could. This was in a period of time where the latency of transmitting data over the internet was meaningful enough that getting it wrong and being too far away you'd get a signal, but your signal would be delayed. Then you'd submit an order, but the order would be delayed, and in that cycle time, even if it was just fractions of a second, could mean that you could miss out. And he was really going for pennies on his high frequency trading. Pennies per stock, or per share, I should say. So you're absolutely right. Nanoseconds, absolutely right. So, but in any case, you talked about one method or one widely used approach to trading, and you use the term swing. So talk to me about if you have some familiarity with swing trading. What is that?
Again, this could be another example of maybe holding on to position for a week or so, and you're looking at certain price levels where you believe this would be a good area to buy or sell. Also, another aspect of it is technical analysis, where traders will look at price patterns or price performance or certain indicators like volume to add to their decision on whether or not this would be a good time, whether or not to go in and out of position. For example, if you're looking at a particular stock right now and it's been trading around $40 and it goes to 41, back down to 40, and it kind of forms this kind of pattern that you view could be a support level. This could be an indicator on whether it goes below it or above it, on seeing the movement of it is another element of trading, looking at these different indicators. And people could be looking at quotes for the entire day and just looking at it to determine certain levels on where they want to make purchases or sell.
Mm-hmm. Well, yeah. So the reason I think it's useful for us to talk about the different approaches to trading is because in my view, while there's certainly a lot of different ways to skin a cat, the truth is that most of the traders that I know that are successful in the long term as traders, and when I talk about that, I'm talking about days to weeks to months as opposed to seconds. Although seconds or minutes, it's certainly workable there too. But who are holding on for a few days, weeks, or months, they are relying on a handful of, as you pointed out, Adrian, patterns. And so when we talk about patterns, and I don't mean, we could maybe spend another time on a different episode just really going deep into trading. That would be interesting and fun for me. But I would say that there are a handful of these positions that usually are methods that usually involve some derivation on the concept of momentum. And that can be momentum that's up, or that's momentum that's down, but it's momentum of price. First and foremost, price. So how is price changing over time? And then there are other things that are built around that, which are volume and the volume of shares that are being traded. If you have a big move on a day, for example, let's say a 4 or 5% move in a stock, and it's accompanied by volume that's 3 or 4 times the average volume of over the last, I don't know, let's say 10 weeks of trading or something like that, that says something triggered something there. And usually that means that institutional buyers, as opposed to retail buyers, although after our conversation of a couple of weeks ago about GameStop and some of these things, maybe it's the Reddit boards are starting to go crazy as well, and Robinhood. But typically it has been a signal of volume, massive volume, not just a movement in price, that says, okay, something's happening here. Somebody wants this. And if you can have the big institutional players wanting something, then finding a time where you can, at a lower risk point, enter or join their decision to commit to that particular stock, that can be fruitful. It's the question of being early enough and doing it at a point that's where the risk is low enough that you're not the one who's buying at the top of the market in that particular thing. So
Yeah,
you mentioned, go ahead.
Yeah, that's a great point, Erik, and also another another element of technical analysis are moving averages, whether it's a 20, 50, or 200-day average that follows a particular price over time, looking at certain levels. If a stock is moving above or below a certain moving average is also something to look at. And I think a important part too, kind of contrasting the trading and investing, is the different transaction costs. Where if you're investing at more of a buy and hold, more of a passive strategy, you're going to have a lower cost than someone that's trading constantly, whether it's days or weeks, is an important distinction to make.
Mm-hmm. Well, so I'm gonna just circle back to this idea of I'm sounding like Jen Psaki. I'm going to circle back to this notion of swing trading. So swing trading is an approach where the particular security that you're interested in trading has been moving up, and I'm going to use your reference of moving averages because that helps. And then it has a little bit of a cooling off period. And the cooling off period, it kind of comes back in and settles in at some form of what traders or technicians would call support. That support might be a previous price level. Let's say that it had been trading at 25, or had kept bumping into 25, and then people would start selling, and it would come back down to 20 or 15 or whatever, and then bump back into 25, come back. Finally, it breaks through 25 after a few weeks or months or however long, maybe years. And now it's at 35 or 30. And now if it settles back, it has a cooling off period after making that, and it more or less hovers around 25, you can think, all those people who used to think 25 was impossible, maybe that what used to be what we call resistance is now an area of, from a technical standpoint, support. Maybe this is a lower risk point at which to enter and hope for, if this underlying momentum has been strong enough, to enter that trade with the hope that, or the expectation that it'll move higher again and pushed up to 35 or 40 or beyond, whatever the case might be. And then moving averages can be another form of that support, or for the oppositely, if the markets are declining, then resistance. So so you've talked about different moving averages, and you've talked about some indicators and this sort of thing. The one thing that I think is really important to get right here is risk control. And this is, by the way, I think would be true of investing, trading, or speculating. And we'll come to speculating in just a little bit. But with investing, your first method of managing risk is, as you pointed out earlier, Adrian, diversification. So you don't have all your eggs in one basket. But on a trade, you are, it's a more concentrated analysis here. You're not just allowing time and overall underlying fundamental market growth to do the job for you. You're watching the particular price movement of this particular security. And that's really, at this point, almost all that you really care about is what's going to happen with the price. So in terms of your thinking about managing risk, Adrian, how do you think about that?
Well, an important part of this is I feel like it's allocation.
Mm-hmm.
Again, separating certain areas and just seeing your overall picture and seeing what would be what losses are you able to take, what losses can't you take, how this will affect your overall situation. I think is a great starting point when it comes to making trades.
I think that's right. And so traders have generally some rules of thumb. And there's been some studies done on this. If you were to take a coin and flip it, and just count what was some of the longer series of heads that you had, heads in a row, and how many series of tails did you have in a row? And you'd sometimes say, well, it's supposed to be 50-50, but wow, I was able to produce some instances where I had, let's say, 10 tails in a row. So if that's the case, you sort of think about that from the standpoint of a trade. If a trade has, probably has a slightly positive expectation, and that's what we were talking about earlier, is having momentum on your side, having perhaps that same industry sector on your side. The strongest stock in the strongest sector is a interesting place to focus your energies and interest for some of these studies sometimes. But you have all these things on your side, so you're trying to get better than a coin flip of probability on your side. But even if you had only a coin flip of probability, you'd have to say, okay, how many instances of separate trades could I endure? Let's say I had 10 consecutive losses. What would that do to my underlying trading capital? And how much of that trading capital would I be willing to lose if I had X number? It might be 10, it might be 20, but how many, a long string where it's not heads and tails are about 50-50, it's overwhelmingly tails. So the rule of thumb that I used as a trader, and I think is a fairly common approximate rule, is don't ever put more than 2% of your trading capital at risk on any single trade. And so what does that mean? Well, again, using this example of this security it was bumping against 25, bumping against 25, bumping, then it finally breaks through to 30, then it 30 and settles back to 25. I might say, the bottom of this formation, because the stocks don't have only one price during a day. They'll have a range of prices during the day, a high, a low, an open, a close. I might look and say, you know what, I'm ready to enter this stock if I have this thing confirming that it's moving back up out of this area of what we called support, hopefully accompanied by a moving average. If I have that move higher again, then I want to also define before I enter the trade where I will get out if my thesis is wrong. In other words, if I wind up with this coin flip, a tail, not a head. And so I might say, I'm going to enter, it pulled back to 25. I'm going to enter if it goes to $25.05 on good volume, or $25.25 on good volume. Like they're not just trying to fake me out. And
I really like this approach, Erik, and I think it's extremely helpful. Where you say you have these rule of thumbs or certain principles or certain strategies to always go back to always reference, to always manage and mitigate that risk. I think is extremely important. I think we discussed this earlier. A big thing about trading too is emotions and liquidity and just the constant buying and selling, whether it's days, weeks, or months. This could really, let's say you're having a lot of successful trades, it's going very well for you. This could make you stray away from maybe some of those principles and rule of thumbs that might have gotten you to this place, where it's always good to make sure to always mitigate your risk, always to go back to certain principles or strategies you've been using, because sometimes the patterns could line up. The moving average, you could be breaking above some important moving averages and everything could look good, but your timing may be wrong, and markets sometimes are unpredictable. Movements are unpredictable, even as everything may line up, it may seem correct, but being able to stay focused and making sure that you have those risk controls in place, and making sure that you're using your certain controls and strategies and rule of thumbs that can help protect you is extremely important.
Yeah, I agree with that. So I want to just go back to this trade then on the basis of what you said, because you talked about, managing the emotion and having an approach to it. So let's say I got in at $25.25, and the bottom of the trading that in those last couple of days was at $24 actually. I might say, if it goes below 24, and my thesis was wrong, it's not ready to go higher, I'm going to get out if it punches through below 24, I'm going to have to exit this trade, sadly. And I might not get out though if other people have defined the same place to sell and get out of the trade. I might not actually get out until it's maybe $23.75. So right there, I have $1.50 at risk, from $25.25 where I entered to $23.75 where I think I might be able to get out. $1.50. Let's say I have $100,000 of trading capital. Okay, how many shares can I buy? This is called position sizing. How many shares can I buy if there's $1.50 potential loss? Well, I can essentially buy about 1,300 shares. Because if I buy at that point 1,300 shares, roughly speaking, and I lose at $1.50 each, I'll have lost about $2,000 on that trade. And so, but some people will just not have that sort of position sizing question in their minds at all, and will just go in with the whole kit and caboodle. And so in my case, just using that example that I just gave, I'm probably in for something like, well, if it's 25 and a quarter, doing the math here, $33,000, $34,000, $35,000, something like that, but not the full 100,000. And I have a firmly defined stop. So managing the trade is probably is as important, I would say, as deciding where to enter, and just not allowing yourself to lose so much capital that you can't come back to fight another day. So, well, anyway, and then the last thing I'd say about trading is just having a target where you take profits. If somebody did what I just said, but they always just about wet their pants when the thing moves from $25.25 to $25.50, and they're only taking a quarter of profit when they had $1.50 at risk, it takes a lot of wins of 25 cents to overcome those periodic losses of $1.50. So you have to have a belief, or I would say a patience coupled with a reasonable, well-grounded belief that you can get out of that trade. Let's say if you've got $1.50 at risk, I'd say don't settle for less than $2.25 of, don't start selling until your position is moved up, let's say 2.25. You're at 27.5 on that position before you start to sell even the first share. So that way you can shift what you're trying to do is, even in a 50-50 world of heads and tails, you're trying to shift the gains to be greater than the losses to come out with a result that you can live with.
Yeah, that's a great point, Eric. And I hope we do have a future podcast more on trading, because I feel like this could be a whole nother discussion. And I like how you ended with it, having those certain targets and goals in mind when you have certain position sizing and you're making these trades. I think is extremely important. And now we can move on to our last strategy, our last topic, which would be speculation. And this is the more aggressive one. This is the one where people say it's more high risk, high reward. And this is where it's extremely important to have those risk control measures in place, and to have a conversation. How we always talk about, it's the individual, breaks down to the individual. Having that conversation where if you are taking on a speculative asset or investment, seeing how much to allocate is a good starting point. Do you want to go a little bit into that, Eric?
Well, I think you put it right. I think, generally speaking, when I think of speculating, Adrian, I think of it as there's an expectation of a genuinely outsized possible return, right? You're thinking, this could hit it big. This could hit it really, really big. And so on that basis, I'm willing to commit a small amount of capital. But usually the things that have that people imagine have, let's say, that people imagine have the opportunity to hit it big, also have the probably an above average possibility of losing big. So on that basis, it comes back to the whole notion of what I was saying a minute ago. It was about position sizing. How much of your capital are you going to put at risk on that speculation? And so and let's say, coming back to this notion of something that's $25, if the movement on that thing overnight is often $5, and the next morning I could wind up with my position down at 20 or 15. Okay, coming back to my position sizing thing, if I've got, let's say, a potential $10 per share loss, and I've got $100,000 to work with, and I don't really want to lose more than 2% of my portfolio. All right, I can lose $2,000 on a $10 move. That's 200 shares. So instead of 1,300 shares, it's 200 shares. So it's just a different way of thinking about. It's extending the principle of risk management and loss management. Maybe is the thing that I want to put loss management into a much smaller package. Now, I'm gonna say, Adrian, when you think about this, and of course you work closely with Roshan, and you work with some other advisors as well in the DC area, Washington DC area, and I'm here in the Midwest. So, do you have clients in your practice that are eager to take part in a speculative approach as part of their overall wealth development strategy?
Yeah, Eric, we do, and that's where it's important to just discuss this and have that conversation. Go over the potential returns, go over the potential risks. Talk about also reallocating and then rebalancing in the future is also an extremely important point, because, like you said, this is an opportunity to really hit it big, or potentially losing a loss of the principal that you did invest. And let's just take the example of the position sizing increasing when you take on this speculative investment. It could become not a substantial part, but it could just increase a percentage of your overall portfolio. And seeing, like how we discussed in trading earlier, maybe have a target, have a set goal in mind where you do start maybe selling some of the position or just readjusting whatever it may be. But I think having that conversation is extremely important, seeing what could be a viable portion of your portfolio to allocate it to. Because again, we have to consider your overall financial goal, your overall lifestyle, your future expenses. That's also an extremely important element of your financial picture. And just seeing what we can do, what we can't do, and just laying out all the options, I think is a very good starting point with this.
Mm-hmm. Well, it's interesting. So I maybe have one or possibly two clients in my entire practice that I would call speculators. And so it's interesting. I don't know why it is that maybe you're dealing with a younger set. I don't know. Maybe the Midwest has a little bit more conservative.
But it is a conversation that
Uh-huh.
we have when we go over the whole financial picture. Because again, there are just
Hmm.
so many elements, and it's just
Hmm.
one piece of the overall puzzle. And it is a conversation that might not come up in the beginning of the conversation, but later on
Hmm.
down the road.
Interesting.
I think like the biggest thing that comes up is it was just nonstop with these this Reddit. They call it the 16 meme stocks. All these companies are just being moved. And the thing with speculation, it does create certain asset bubbles. People do
Hmm.
talk about it. Another familiar one comes to mind is cryptocurrency,
Hmm.
where the expectation is that you put in a certain amount, and whether it does have a big swing, a big price movement up, there's also that risk that you might lose a good portion of it. It's just a conversation to have to see what's suitable for you, having those important risk control elements in it, and seeing how it fits your overall picture on an individual level. And that's where we're willing to have a conversation with you and discuss this and look at your overall financial plan and how your investments are set up to see what are the different avenues and approaches that we can implement in your future.
Hmm. Interesting. Well, I guess I would just want to kind of wrap up about all of this, that we've made distinctions between these things, but what would you say are the commonalities? What principles do you think are true across every one of these categories?
I think the biggest thing that comes to mind is the risk reward element of it is extremely important. Where if you're taking a more aggressive approach, determine what percentage of that is going to be your overall portfolio, and also seeing your overall time horizon on when you're going to need these particular investments or your sources of funds to fund certain expenditures. Your lifestyle, I think, is really important. And again, these are all strategies that may work for you or may not for you. You might find some of them would be a good fit, or you like sticking to, let's say, a more traditional or more passive approach. Whatever it may be, just knowing that there's a lot of different options out there, a lot of different ways to use your funds when it comes to looking at the financial markets is a great conversation to have.
Mhm. Yeah, I would agree with that. I think the commonalities between all of these are, for me, discipline, a plan, emotional self-control, because you can have a plan and you have to have a systematic rule-based approach, but then your emotions don't allow you to see it through, especially when it's painful, or when hope starts to take over reason. And you start to make I think ill founded judgments about some of that. So emotional control, risk control, capital preserve, or guarding your capital. It's better to, I would say, miss an opportunity, or to get out of an opportunity that's not going your way, so that you can live to fight another day. The phrase that fellow traders and I would use is, well, I'll just have to catch the next bus. There's one bus that I didn't get on that bus. There's going to be another bus coming. It's not the end of the world. Emotion driven decision making and all of this, as opposed to a systematic approach, is not fruitful, generally speaking, for most people. In fact, just using the example of the biggest hedge funds in the world, generally speaking, the biggest hedge funds and the durable ones that have been around for decades, as opposed to the flash in the pan type ones, what they have literally are thousands of strategies that are simultaneously working in diversified markets. They'll hire hundreds, if not thousands, of analysts who will each be working on these separate strategies and using, for the most part, rule-based approaches as opposed to sort of more what I would say qualitative or subjective decision making on things. And they're just trying to find where they can get that tiny, tiny little edge. I think a good example of this is to think of themselves more as the casino than the player at the casino. The casino wins in the long run. Well, can we agree with that? The casino wins. Why does the casino win? Because the casino has incremental, tiny probabilities on its side, and in relative to the total base of its capital, tiny bets on every single thing. So if you can have tiny bets with a slight probabilistic edge, and you never put your capital at too much of your capital at risk at any one time, it can work. It's just then it's just a question of finding out what rules can you follow, what principles or systems or approaches or disciplines can you follow that will get you that edge in the long run. So anyway, there's musings about speculating and trading and investing all rolled up.
Yeah, it was a great conversation to have with you, Eric, and I love to even just extend the conversation on a future date to hear more about your kind of history with trading, and it was some great stories that you brought up today, and I really enjoyed some of the examples you used. To our listeners, thank you for joining us on another episode of the Retirement Lifestyle Show. We hope that you've learned something new today, and we're always open to have the conversation with you. You can find our information on the show notes, and go check out our new YouTube page. We're putting up videos weekly now on some of the podcasts that we're listening to. Thank you for joining us, and this has been another episode of the Retirement Lifestyle Show.